He runs one of the highest-rated private wealth advisory teams in the country at Morgan Stanley. He's Chris Toomey, and he's back here at Post 9. So it's priced to perfection, priced for perfection now?
Yeah, I would say almost the whole market is right now. I think everyone got excited about what was happening with earnings, but this was the whole Wall Street game going into the year. Expectations were earnings going down 4%. April 6th, earnings were expected to go down 16%, right? And so if we're down 8%, that looks like a beat, when in reality, the trend still is very negative.
Sure, but if the trend isn't as negative as some were, calling for, that's a whole different ballgame, potentially.
Right, but then you also have to look at what the market's priced for right now, right? So if you look at the price of the market right now, it's over 18 times in a situation where we now officially are going into an earnings recession, and there is a 50-50 chance, depending on which way you look, as to whether or not we're going into an actual economic recession. So in that environment, do you really want to put an 18 times multiple on the market? Probably not.
Well, maybe you're willing to put a higher multiple on the most mega of mega cap tech names, because you still want to go for quality. If you have to be invested, you still want to go for quality.
Right.
You still want to go where the money is, and you still want to play a little defense. And if you can do all three in that space, why not?
Well, why not is because if we are going into an economic recession, you're going to have a problem, right? So, I mean, if we remember the story, the beginning of the year, economic data is looking better, inflation's coming down, we have no landing or soft landing, and so equally weighted, the S&P 500 looked really good. Then we had this whole situation where the data started turning, and then the banks really had a problem, and you saw that 2-year crash, right? And then this, all of a sudden, when rates are crashing, you also get the sense that long-duration assets are going to do well. So you had people running into tech, which I could say is that sequential next domino with regards to the market falling out.
The market doesn't fall out, though, unless big tech falls out.
Big tech has to come down. It can't, because it's such a huge component to the underlying economy.
I'm just wondering what makes you think that it's going to, with all of the... Now, granted, it may be overhyped in terms of AI. However, maybe that's the game changer that some suggest that it is, and you're just getting started with some of these stocks, even ones that have doubled, like Meta, for example. There was a positive note from one firm out today suggesting this is just the beginning, this turn.
Right, but I think the thing is I don't think the technology industry is immune from the overall economy, right? And I think if you talk about what's being priced into the market right now, what's being priced into the market are 4 rate hikes and 200 basis points of cuts, right? And so I think you've got door number 1 and door number 2, and both are not good options, right? Door number 1, we have those rate cuts. The reason for those rate cuts is that there is clear confirmation with regards to the fact that the economy is really in a recession, and we need those rate cuts, right? That's door number 1. Door number 2 is we don't get those rate cuts, the market's pricing them, and the market's going to have to come down and reevaluate the fact that we didn't get that 200 basis points of cuts. And then taking a look at that scenario, you go back to your friend Professor Siegel, who is now demanding that we get those rate cuts. Otherwise, we're going to see a really messy market.
Let me ask you this question, because some people have suggested this, that rate cuts, now I know you say, well, they're only going to cut rates if we're falling apart. Rate cuts are always bullish. Tell me why they're not. Tell me why they're not. Well, I'm not talking about in the first, 5 minutes or the first 5 days. Tell me why they're not.
Well, typically, if the yield curve is inverted, the economy is going down, typically that means that we're cutting rates for a very specific reason. We're not in a situation where we're in this economy that's growing rapidly, which is a situation where we actually have to cut rates in order to keep the economy going. This is a situation where we are turning lower, and we need these rate cuts to keep the economy from really going much lower. So in my mind, I think the thing is we need something that's going to preempt those rate cuts, and that preemption is going to be negative for earnings and pull down stock values.
Sure, but I mean, ultimately, like, 08, 09, when the Fed starts cutting rates, obviously the environment's still pretty bad. Ultimately, it ends up being one of the greatest bull markets in the history of bull markets, if not the best ever.
But after the shakeout, right?